Hi, Tim Biggam for Delta Derivatives, Option Hedges and Edges, taking a look at a market that's running into a little overhead resistance at that 2,600 level at the S&P 500. Certainly a big two-day rally here as we kind of wait the Fed minutes and the start of earnings season. More importantly, implied volatility vis-a-vis the VIX has gone from over 30 less than a week ago to approaching 20 here. I'm jumping in and actually thinking things may be getting a little too over-exuberant here, buying a UVXY call diagonal. UVXY is 1.5 times the daily VIX, so I'm buying next week's 75 calls. They're about 5 points out of the money. Selling this week's 76 calls, paying about $1.50 for that spread, just looking for somewhere along the way for the market to have a pullback here, which should get the UVXY going here. This was over 90 not too long ago, has collapsed down below 70, so I think a little too far, too fast, both on the VIX and the market as well. Otherwise, taking a look at some usual option activity in HUYA, a Chinese online gaming stock that came public back in May, got all the way, went from 15 to 50, pulled back all the way to 15 last week. Someone jumping in, buying the February 20 calls in size, repeated call buyer, implied vol went from mid-60s to almost 80 here. So I'm following along with that call buyer, but buying shares, selling these comparatively expensive Feb 20 calls, leaning bullishly with that call buyer. Last I looked, the stock was in that mid-18 range, getting in for about 1680 net on the trade, looking to lean bullishly with that call buyer, more importantly capture that big implied volatility spike up. So I think a little caution warranted here. Chinese talk, certainly earnings season coming here. We had a warning out of Samsung after Apple's warning, so although stocks may have seen a short-term and maybe a meaningful low here a week and a half ago or so, I think the all clear has not yet been sounded. So until next week, as always, here's the good trading. Take care.